Good morning, everybody. It's Monday, August 7th, 5:28 a.m. Central Time. December corn futures down 1.25 at 496. November soybeans down 26.5 at 1306 3/4. December Chicago wheat up 12 at 672 1/4. December Kansas City wheat up 10.5 at 779 3/4. December spring wheat is up 3 at 840 3/4. I think the soybean market is down sharply on weather. Why don't we start there?
Large areas of the U.S. Corn Belt saw substantial weekend rainfall. Central Illinois, northern Indiana, Iowa, South Dakota, Missouri, and Kansas saw amounts of up to 2 inches or more. The forecast is wet again this morning. The 10-day Euro and GFS models offer widespread rain across larger areas of the Corn Belt and U.S. plains. On average, over the next 7 days, temperatures across most of the country will trend below normal.
These weekend rains were really good for the places that caught them. I mean, look at central Illinois. There were places that caught 3 or 4 inches of rain, and that wasn't everywhere, but there were large areas that saw 1.5 inches, 2 inches, 3 inches. Same goes for parts of Missouri, parts of Iowa, western half of the state in particular, some of southern Minnesota. A whole bunch of South Dakota got wet. Southern portions of North Dakota, a lot of Kansas caught some rain, Oklahoma, down into, say, western Kentucky, western Tennessee, places like that. So I think that these weekend rains paired with a non-threatening or call it bearish forecast, it's wet, it's moderate in terms of temperatures. This is all seen as being a deal that will add bushels to the soybean crop, or maybe a bushel to the soybean crop, which is a big deal on the balance sheets. But the soybean market reacting to weather in real time here. The corn market or corn crop can certainly still be helped by August rains. July, of course, is the bigger month for corn, crop potential, all that stuff. But these rains absolutely do not hurt. So the weather is seen as being a bearish input for row crop prices and soybeans in particular this morning.
U.S. farmland values have surged this year. USDA released its annual land values report on Friday. U.S. farm real estate averaged $4,080 per acre in 2023, up $280 or 7.4% from 2022. Cropland values averaged $5,460 per acre, up $410 or 8.1% from last year.
This is pretty phenomenal stuff when you consider the meteoric rise in interest rates that we're able to tack on these sort of gains in 2023 versus last year. Where you saw the biggest percentage increases would be in kind of your areas outside of the Corn Belt. Look at, say, Michigan in terms of cropland value, up 11.3%. Wisconsin up 11.8%, Minnesota up 10%, North Dakota up 13.2% in terms of cropland values versus last year. South Dakota is up almost 13%. You look at Nebraska up almost 14%, Kansas up 16.6%. Now your I states, your central Corn Belt states, saw the smallest increases in terms of like your corn and soybean areas on a percentage basis, but Indiana average at 8,400 an acre, Illinois average at 95.80 per acre. This is phenomenal stuff when you consider the environment. You've got certainly a lot of farmers that would like to buy more land. You've got a lot of outside money that's on the sidelines that would like to own farmland. This has been, of course, a very strong asset over the years. They had this chart in here that goes back to 2009. Of course, farmland has more than doubled cropland values since 2009, and really a lot of things have about doubled in that time frame. So farmland still very, very sticky.
So if you guys are not already subscribed to our premium content, you need to do so. Joe, can you tell me about a couple videos you put together last week?
2 videos late last week that I think you guys should check out. So our mailbag videos, this is where I take questions that come in from subscribers, and a lot of them revolve around grain marketing, capture and carry, things like that. I think we had 7 or 8 questions. We always get really positive feedback on the mailbag videos. And then our newest video, this is going to be a recurring theme, social media circus. We take comments. Mackenzie did this with me. I thought this was a lot of fun.
It was a blast.
Yeah, so we took comments from our YouTube page, from our TikTok page, from a bunch of other places, and kind of just ran through them. There was some funny stuff. There was some serious stuff. It's kind of a lighter Friday video since we do so much like serious grain marketing stuff during the week. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. I'll send you over those videos. This is a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. Just a ton of info direct from us, guys. It takes like 1 minute to sign up. You can do it on your phone or on your computer. You just need your credit card.
Russia has promised retaliation for Ukrainian attacks that occurred late last week. So on Friday, Ukrainian drones struck a Russian tanker in the Black Sea near Crimea. Ukraine also attacked a major Russian port with drones on Friday. In response, Russia announced on Saturday that they would retaliate. Experts believe the Ukrainian attacks will most likely increase the risk of Russian attacks on Ukrainian ports instead of put pressure on Russia to come back to the Black Sea grain deal.
Okay, so they did retaliate. There was a story out yesterday or last night. Russia unleashes missile and drone strikes against Ukraine. So it's more back and forth. I think a lot of people thought coming into today that this wheat market in particular would be acting much, much better on this news, on these escalations, and the idea that the war has kind of made its way into Russia. But it seems like a non-starter for the moment. I don't know what it's going to take, but this is not enough because the wheat market in general acted poorly last week, and you've got just a marginal rebound in price action here this morning.
Large money managers trimmed their net long position in the corn market last week. CFTC released weekly commitment of traders data on Friday. During the week ending August 1st, the funds were net sellers of 12,000 contracts of corn. They were net sellers of 22,000 contracts of soybeans, and they were also net sellers of 15,000 contracts of SRW wheat for the week.
You probably saw some more selling late last week. So the CFTC data is always accurate as of Tuesday, but we don't get it till Friday after the close. At Friday's close, the private group's estimating that funds were probably flat corn to maybe just marginally long. Still net long about 85,000 contracts of soybeans, still net short about 70,000 contracts of SRW wheat. So kind of a mixed bag here, certainly.
To boost supplies and control prices, India is considering reducing or removing a 40% import tax on wheat. The country may also lower the limit on the amount of wheat stocks millers and traders can retain. So back in June, to lower wheat prices, India placed restrictions on the quantity of wheat inventories that traders could retain. Over the past 4 months, wheat prices in New Delhi have increased by 12% due to tight supply, which has been caused by erratic weather. India's wheat crop rose to a record 112.7 million tons this year, up from 107.7 million tons in 2022.
You very rarely do you hear about India and wheat. Nevertheless, they are a big dog when it comes to the wheat market or wheat in general. India is the world's second largest wheat consumer. China's number one. India is number two. But India is mostly self-sufficient. They don't import much. They don't export much. They're just kind of living in a vacuum in terms of wheat. If this turns into a deal where India does need to buy some sort of material amount of wheat, which for them wouldn't be like, I mean, wouldn't be much. Like if they need to just increase stocks or whatever by 5 or 10%, that would be huge in terms of the global wheat market. So this is something to keep an eye on. We've seen this news, which I think implies that they'd like to import some wheat, but we haven't actually seen it yet. So keep a lookout for that.
So last week, 11 Russian and Chinese ships sailed dangerously close to the Aleutian Islands. The ships were tracked by 4 U.S. destroyers and a P-8 Poseidon aircraft before leaving the area. Experts claim the fleet was the largest to ever approach American shores. Both the Russian and Chinese embassies claim the ships were conducting training activities and that the ships' actions weren't targeting Washington. Russian warships and Chinese research vessels have been spotted in the Arctic before. However, it's rare for them to form up in surface action together like they did last week.
Yeah, this is kind of weird. I don't think this means anything for the market right now, but these geopolitical tensions, East versus West, whatever you want to call it, have got to be paid attention to. You just never know what the next thing is going to be. And these geopolitical, when the geopolitics and this sort of stuff impacts markets, markets are always difficult to impossible. This makes it really, really difficult to impossible when you've got these unknowns when it comes to headlines. So U.S. versus China-Russia tensions, I guess. Keep an eye on it.
The U.S. economy added fewer than expected jobs in July. According to Friday's jobs report, non-farm payrolls expanded by 187,000 last month, lower than the Dow Jones estimate of 200,000. The unemployment rate unexpectedly dropped to 3.5%, the lowest level in over 50 years. Average hourly earnings rose 0.4% for the month and 4.4% on an annual basis, both stronger than anticipated. Following the report, market expectations for the Fed to maintain rates at its September meeting increased slightly to an 83.5% chance.
So your unemployment rate at 3.5% is like bottom of the barrel. I know the doomsdayers will tell you, oh, you got to look at the labor force participation rate or whatever. I mean, this is good. The labor market's really strong. Here's the chart of non-farm payrolls, which was totally destroyed by COVID. It's like you can't look at a long-term chart because it's got beat up so bad with your 2020 crash and then spike. But this wasn't bad. The market didn't seem to mind this. And now we're thinking a pause from the Fed in September, at least an 85% chance of a pause the way that it looks. Mackenzie, give us a quick cattle market update.
Cattle futures closed higher on Friday. Live cattle futures were an average of $1.40 higher. Feeder cattle futures closed an average of $1.91 higher on the week. Both live and feeders were up. Cash cattle trade was light but higher last week. In the Western Corn Belt, cattle traded $2 to $4 higher at $1.88. There were also some sales reported here in Nebraska at $1.88. That was $2 higher than the week before. Choice box beef ended the day on Friday at $301.79. That was down 22 cents. Select ended the day at $276.48. That was down $1.83.
Outside markets fairly quiet to start the week. U.S. dollar's up a little bit. Stock market is marginally higher. The S&P's up 10. The Dow's up 45. Bonds are off. Crude oil is down 89 cents in the September WTI at 81.93. Have a great week, guys. We will talk to you Tuesday.